Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from chartsandmarkets.com runs down the major markets. A positive U.S. jobs report has pushed up the S&P and Dow, and uranium appears to be gaining life. Longtime BC trader Victor Adair gives us his view on why high-tech has gone from being the least popular sector to the hottest. He also chats about energy, gold, the U.S., and Canadian dollars. Market historian Bob Hoye joins us to discuss AI Mania. Is it the same as the overenthusiasm that led to the 2000 dot-com bust? He takes a look at a number of business headlines that caught his attention this week. We'll talk to Ross Clark right after this.
Recyclico, making lithium-ion last forever. Recyclico's patented recycling process achieves up to 100% recovery of battery metals from lithium-ion batteries for electric vehicles, including cobalt, lithium, nickel, manganese, and aluminum. Recyclico Battery Materials Incorporated trades on the TSX Venture AMY, on the OTCQB AMYZF, and Frankfurt ID4. For more information, visit recyclico.com or phone us at 778-574-4444. Recyclico, making lithium-ion last forever.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from chartsandmarkets.com, where you'll find insightful market commentary and timely technical analysis. You can find him on Twitter at Charts by Ross. Welcome back to the show.
Pleasure to be back, Jim.
How did the stock markets do this past week?
We got some real, a week ago it was all about NVIDIA and the AI. And this week, we've got a little bit of participation in other markets, in particular on Friday when the employment numbers came out and jobs growth in the U.S., 339,000, above estimates. So there's the market on the upside. The S&P, the best level that we've seen in months, up a good, 60 points or so. We're up a bundle on the Dow as well. Not getting the breakout on the Dow, but pretty good price action off the bottoms. And, there's so much money sitting on the sidelines in money market funds that when this stuff starts to move, there's, that quick reaction from those who are on the sidelines who are looking to get back in. And we take a look at the action we've seen here in the NASDAQ, where we've talked about maybe the top 6 or 10 stocks really have pulling the index along. And when you look back, any market that is overbought and then goes into that next phase of just being exponential on the upside, you've got to be careful of those. That's what we saw in the cryptos a few years ago. We saw it in the cannabis stocks. You go back to the precious metals of the early 2000s. These markets, when they gain momentum, you've got to put away the short-term targets and objectives and watch to see how they do in terms of their pauses during the rallies and what kind of pullbacks they have. So at this point, things like the Qs, be looking for the 20-day moving average to provide initial support. That's going to take a bit of a pause, probably a week or two, of sort of backing and filling before that moving average could catch up to the price. So, I wouldn't be looking to fade this market at all. In particular, when you look at the NASDAQ, historically, it likes to create rolling tops. So you go from an overbought, an extreme overbought, where we are now. You get that mild pause and correction, then you get another run to a new high, and it's on that one that you want to be looking very, very carefully at how the money flow oscillators like the accumulation distribution or the Chaikin money flow or the demand index, how are they doing? Are they putting in a divergent high? Type of thing you would look for in a relative strength index, but in this case, you want to look at it in terms of the money flow that's coming in. So when we do finally see that, and that could take the better part of weeks for this rolling process to happen, that's where you want to turn defensive as far as the cues are concerned, and invariably, if the S&P and Dow are failing to do much on the upside, even though we've had a great end of this week, you want to be very cautious on those as well, because the best times to buy are typically going to be out in October, November.
What's going on with gold?
Gold and silver both had got a little overdone on the downside a week ago and into early in the week this week, and then a pretty good bounce. Retraced Fibonacci 38% from the highs of early in the month on the rally into Wednesday, Thursday high, but with the employment number, U.S. dollar turned strong, and with that, the precious metals came under pressure. So we're still looking for a bottoming in precious metals here in this month through July. Ideally, a little lower than we are right now. And that was a good resistance level that we saw midweek, and ideally that will stay as the lid for a while until we put in a better low.
What's going on with crude?
Crude down into the early part of the week and got a little oversold, rallied back at the end to $72. The key there is the 20-week moving average. We bid in a hard, or this is not a hard downtrend, but just a methodical downtrend here for months and months now. This with a good consolidation around the $70 level. But rallies, the initial rally was up to the 50-week moving average. That failed a couple of months ago. The rallies now are finding a lid at the 20-week moving average. That's around 75.5, so we could still be a bounce up into that level. But as long as that stays as the overhead resistance, then I still think we need to see one more good low before we can put in a sustained rally. Now, our work does have some guidelines in terms of what to look for as we go into a bottom and the reversal. So, we keep that for the subscribers, but there should be some pretty good opportunities here in the coming months on the oil market.
What's the story with the U.S. and Canadian dollars?
Well, the U.S. dollar has been basing since February. Got that good double bottom, had a nice rally up above the moving average resistances, but having trouble at the 104 to 105 level on the dollar index. The uptrend, though, is just nicely in place here. We had a 2.5 day pullback, and as far as we can see, the trend looks as though it's still going to be higher from this level, looking to test the 105.5 level. And, with that, the Canadian dollar is going to have some pressure. There's, unless we can really get something going here as far as the oil market is concerned, then I think the Canadian still has that 75-cent lid that it's had since October, November. It's just trading range is the name of the game for Canada for now.
In our anything else file, what's happening?
Well, the one area that has been just really quiet for the last year or so, but that we've been favorable with has been the uraniums. You look at something like Cameco, it had that beautiful bottom, 5 years in length from 2016 through 2021, and then we caught the breakout down around the $10 or $12 range, and this has been biding its time now in the mid-20s. But as of this week, the uranium price itself has started to pick up. We're looking at a good base there, with it breaking out now at 54 and change. And if we take a look at the stocks themselves, a few of there's some laggards in there, but the big names like the Camecos are at the point of just breaking out through their large trading range. We've got targets, Cameco, in terms of Canadian funds. It's trading around 30, targets up in the 50s, just based upon the size of the base that has come out of. So it's nice to see. Patience has been a virtue here with this one, but it's got some life in it. Pretty happy to see this one on its with getting some good legs right now.
Ross, thank you so much for the update.
Always a pleasure, Jim.
My guest has been Ross Clark from chartsandmarkets.com. Find him on Twitter at Charts by Ross. Coming up, Victor Adair next on This Week in Money.
Always consult your investment professional before making any investment decision. Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. My guest is Victor Adair. Recently retired from nearly 50 years of being in the brokerage business in BC, but he's still very active in the markets. He's speaking to us from Parksville on Vancouver Island. Welcome back to This Week in Money.
Jim, it's always a pleasure to talk with you. Thank you.
Victor, before you give us a big individual market kind of show, what's your current macro view on what's going on out there?
Well, that's an open door, isn't it?
Well, let's walk through it.
Well, okay, I guess the first thing that pops into my mind when you ask that is how we have shifted from, call it a 2-decade or so deflationary environment to an inflationary environment. And probably the pivot point was like around what I call the COVID crisis, and certainly the reaction of governments and central banks to the COVID crisis. So that, by pivot point, that was kind of at the point in time that we shifted from, just a big picture deflationary environment where we had globalization, technology, demographics that were kind of keeping a lid on prices. And then, as everybody knows, they go to the grocery shopping store, prices have gone up since then. So, yeah, I think that's sort of been one aspect of the macro view, the switch, and maybe a subset of that. And this is my cynical view as a trader, and I don't think you need to be cynical to be a trader, but it's handy, is that people and governments are now less concerned, it seems, than ever with debt and deficits. And I think that goes sort of hand in hand with the inflationary environment we're in. So, if we're going to make a quick wrap on this, then I guess my macro thought, and as a trader, I'm very willing to be wrong because I know I'm wrong a lot, but my macro thought would be that we will have a sustained higher inflation as we go forward from here than what we've seen in the last couple of decades. So I think that will impact people's behavior. That'll impact certainly government's behavior, and we have to prepare for that as how we trade markets.
Last year, the tech sector was the weakest part of the stock market. This year, it's the strongest. Why is that, and what's next for the stock market?
Well, I had this notion about defensiveness. The people that manage other people's money run a lot of money, a lot more than individual guys with their interactive brokers accounts, for sure. Institutional money, whether it's pension funds and all that sort of thing. And those folks had a bad year last year in terms of both the stock market and the bond market were down. And so coming into this year, let's say they were in a cautious, if not just outright defensive frame of mind. And like the last thing they wanted to own was the dogs of last year, which the tech sector was down harder last year than the other sides of the market. So as we started this year, I'm going to call them money managers, were likely underweight in the tech sector. And when the tech sector got a bid for whatever reason and started to rise, they probably became a little uneasy. And the more that tech sector rose, and certainly lately here with the artificial intelligence aspect of the markets, it's just taken off like a scalded cat to the upside. I mean, we have Apple trading around all-time highs now, and some of the other shares have just done so well. The money managers who were underweight either closed their eyes and hoped it would go away, or they started to chase. They had to get back in, and I'm going to say there was more of that than the closing your eyes. It would be hard as a generic money manager to say to your clients, no, I'm going to remain bearish on stocks. I think this is just a brief rally. They're more likely to go in there and buy them. So we've had the tech sector, particularly mega cap tech, has raced away to the upside relative to the rest of the market. I mean, forgive me for being general here, but it seems as though if you took the top 10 stocks in the S&P, the tech stocks, and you took those out of the S&P, then the other 490 stocks really haven't gone anywhere this year. And I see some of the analysts I read say actually those 490 stocks are negative on the year. So the S&P is up on the year because of the narrow breadth here with the high mega cap tech stocks taking it higher, and and now very recently, just this week, and particularly on Friday this week, the market just racing to the upside. It really looked like people chasing the thing higher, people that needed to show their clients, yeah, we're on board, we're in the market. So. Where do we go from here? I mean, I can give you the on the one hand and on the other, and that's I'm not married to any point of view ever in the markets. So I can see the chase carrying on for a while. There's been. Let's actually take a look at what defensive looks like. I mean, we've seen money flow into money market funds like crazy. We've got $5.5 trillion in money market funds. Now, I don't necessarily think all of that is dry powder just waiting for the chance to jump back into the stock market, but it's a sign of defensiveness. I think also defensiveness, the money managers in particular will have gone into things like consumer staples as opposed to tech stocks. They're going to have a higher than normal cash position. We know that there's been buying of hedges that could be buying put options on stock indices or just being outright short the puts. And, there are reasons for that, not just that tech stocks were bad news last year, but, we've had the Fed raising rates aggressively. Money managers had every right to think that there was a chance that the Fed doing that was going to cause the economy to slow down, maybe go into a recession, or something was going to break because the Fed had jacked up rates so quickly after a couple of decades of practically zero interest rates. By something breaking, I mean like the banking crisis, we had March, or we have a credit crisis, a recession. And then lately, of course, there's been this worry about whether or not the government would raise the debt ceiling. I mean, I kind of thought that was overblown, but, the markets get overblown. Anyhow, here we are. The market has broken out to new highs here. I think we've got the NASDAQ is probably at about a 14-month high. The broader indices like the S&P and the Vanguard Total Market are, I think, about 10-month highs, that sort of thing. The Dow has been the laggard, as has been the Russell Small Caps. But we've had this rally, and there is something lurking in the shadows, and that is because the debt ceiling was raised, we're now going to see a lot of Treasury bill issuance from the Treasury. Could drain liquidity out of the system, and believe me, the market runs on liquidity. And, even further into the background, coming up late summer, I think, people have to start finally repaying student loans. There's been at least a 2-year forbearance on that. So now that could be another drag. So I could see, one, that the stock market just keeps running to the upside as people, chase each other and the market gets bid higher and nobody wants to be short. And I could also see this breakout to new highs as a false breakout, and we encounter a lack of liquidity in the market, causes prices to break, and away we go to the downside. I don't have a position, and as I said just moments ago, I don't get married to a position. I got to keep an open mind, So I'm not going to tell you for sure which way it's going to go. I just see two scenarios there, one up and one down, and I'll watch and see what I think is happening, and then I may or may not take a position.
Central banks raised interest rates sharply last year to bring down inflation, with short-term rates hitting 15-year highs. Inflation has fallen a bit, but is still well above where central banks would like to be, or would like it to be. Do you see higher or lower interest rates ahead?
Well, given my thought that we're going to have sustained higher inflation, I think that just equals higher interest rates, certainly at the short end. And let's also talk time frame. You go back to mid-March when the Silicon Valley Bank was suddenly making headlines, and then a couple of other banks after that. At that point in time, the forward market on short-term interest rates was pricing that the Fed would be cutting rates by about 200 basis points by the end of the year. Well, a lot has been forgiven and forgotten since then, and at the end of this week, the central bank, the forward market, is pricing in the Fed to maintain interest rates, raise them about another quarter here over the summer, June or July, and then kind of maintain that rate, maybe lower it a little bit coming into the end of the year. In Canada, interestingly enough, the market is expecting short-term interest rates come December to be higher than what they will be this summer. And in both countries, we're looking for the central banks to kick rates up by at least another quarter. So that's on the short-term kind of time frame here. Now, go to that scenario on the stock market where I said maybe we have the market rally here and then gets blindsided, as it were, by a bit of a liquidity crisis as the Fed moves to rebuild their accounts and student loans get paid down and consumers, chill a bit. In that environment, and the stock market breaks, I can imagine this. I'm not saying it would happen for sure, but I could see the bond market catching a bid, sort of a knee-jerk defensive move that people, over the past couple of decades have been trained, hey, if the stock market's going down, buy bonds and they'll go up. So there you go. But longer term, I think, I can imagine this, and again, I'm willing to be wrong, but I can imagine that bonds will just go down in price and yields will go higher because we're going to be in a more inflationary environment, and nobody's going to, buy a bond with a 3% coupon on it, for instance, when they feel as though inflation is going to be sustained at, pick a number, anything than 3% or higher. I mean, why would you buy the bonds? So I kind of have that's my view longer term, is that given that people understand the purchasing power of their currency, whatever it is, if it's dollars or euros or yen or what have you, it's going down. There's sustained inflation in the market. I don't think there's a real political desire to get inflation down. Now, we had some Republicans recently who were arguing that they would vote against raising the debt ceiling because sooner or later, we got to get this spending under control. They're clearly a minority, whether you agree with them or not. And certainly there's part of me that thinks, hey, everybody's got to live within their budget. But in the real world, that that doesn't seem to be the case. So I think sustained inflation over a period of time is going to keep a floor under bond yields, and I think they're probably yields are just going to go higher.
You were bullish on the U.S. dollar beginning in January 2021, but turned cautious last fall. When we talked last month, you turned bullish again. What are your thoughts now?
Well, I know I'm going back and forth here in terms of time frames, but something I noticed the other day, and you'd think this was obvious, but I noticed it. The U.S. dollar has been trending higher for 15 years, since 2008. And I'm talking the U.S. dollar. It's the U.S. dollar index. So we measure the U.S. dollar against a number of other currencies, major currencies. And you've heard me say once, you've heard me say it a couple of dozen times on your show here, that capital comes to America for safety and opportunity. And I think, despite the recent talk about de-dollarization, how the dollar is going to lose its reserve currency status, and so on and so on. And I noticed, by the way, that some of the countries that have been promoting that kind of idea have seen their currencies trend lower and lower and lower against the U.S. dollar, so no wonder that, like some other medium of exchange. But I think in a problematic world, and we've got problems all over the place, if you personally have some wealth and you have the option to keep it in one place or move it someplace else, like the United States or maybe Switzerland or something, you might do that. And over time and in aggregate, people do move money. And, we've also seen, for instance, again, a shorter-term time frame, at the end of September last year, the euro currency was at about a 20-year low against the U.S. dollar. The British pound had just dropped to, I think, a 37-year low or something like that. They had that debacle with the Liz Truss government. That would have been, about September, October. The Japanese yen was at a 30-something-year low against the U.S. dollar. So since then, the U.S. dollar index has corrected about 50% or so from the run that it had from 2021 to the highs of 2022. And found some sort of a floor at around the 100 mark. I think we'll see the U.S. dollar rise. Previously, a big part of the rise in 2022 in particular was that the Fed was seen to be much more aggressive with monetary policy than other central banks. And, that may or may not so much be the case going forward, but I just think that longer-term trend from 15 years ago is still in play. And I think what really drives that play is the safety and opportunity in America relative to other places. Also, last fall, when the euro was making a 20-year low and then turned and started to go higher, the European stock indices, the major ones, like sort of the European equivalent of a Dow Jones, for instance, we saw French stocks and German stocks, continental Europe, I'm talking about more than the UK here, start to rally along with the run-up in the euro. I think the story was that there were great bargains outside of the United States, whether it was in Mexico or Japan or Europe. And in this case, we're talking about Europe, and capital did flow from America to Europe, and an American who would have cashed in his U.S. dollars, bought euros, and then bought European stocks would have come out far ahead of an American who just stayed in U.S. dollars and U.S. stocks. So there was a run there, but I think that kind of got overdone, and certainly seems to me in the currency market, the enthusiasm for the euro got overdone, and that's one of the reasons here, certainly for the last month or so, I've been trading the U.S. dollar from the long side, buying the U.S. dollar, and my favorite target on the other side has been the euro, because that was everybody's favorite target to jump into in the first place. So I'm talking my book a bit. I've been bullish the euro as I talk to you now, bullish the U.S. dollar, I should say, as I'm talking to you now. I have positions on in my accounts where I'm long the U.S. dollar.
The Canadian dollar fell to a 2-year low last summer, and since then it's traded in a narrow range on either side of 74 cents. What do you see ahead for the loonie?
Probably Probably more sideways, honestly. The Canada has been a bit dull. I mean, I was actually looking at some longer-term charts. I think it's been going sideways in a range of about a 10-cent range for 8 years or something. We always, and I'm Canadian, I'm talking from Canada, we're always looking at the Canada relative to the U.S. dollar. I mean, as a currency trader, however, I make a habit of looking at the Canada relative to other currencies. For instance, here's a great comparison, the Canadian dollar relative to the Australian dollar. And now, all of the things forgotten or forgiven, the Australian dollar is usually more volatile than the Canadian dollar. So if Canada and the Aussie are both rising, Aussie's rising faster and vice versa if it's falling. And also, Aussie's kind of a play on China. You know, Aussie trades to China like Canada trades to the United States. And if China is, like the recovery, the reopening, as they call it, from this year, is slower than had been expected, then, you know, the Australian dollar is a little weaker. So I'll look at Canada, Australia. I'll look at Canada, Euro. You know, the Euro has been, I think, in part weak over the last month here, as people have been disappointed at the relatively weak reopening in China. China is definitely Germany's and Europe's biggest export market. I've been not taking the stuff that dampens some of the enthusiasm to buy euro. So, right recently, as the U.S. dollar has gained against the euro over the past month or so, the Canadian dollar has also gained against the euro. So you might even see, let's say, Canada and the U.S. almost as a block, and you could even include Mexico in there. If you think in terms of, you know, Fortress America or Fortress North America, you know, Canada, the United States, and Mexico, we don't need, you know, the rest of the world for much. You know, pretty self-sustained, which is, you know. So what I mean by that is that we might see that Canada tag along with the U.S. Relative to how the U.S. is doing against other currencies. So the American dollar is up against the yen and the euro and whatever else. Canada probably is too, regardless of what it's doing relative to the U.S.
The gold futures market hit an all-time high on May 4th, but has fallen over $100 since then. Has gold fallen from its highs because the U.S. dollar is so strong, or is there more to the story?
Well, you know darn well there's always more to the story, but yeah, that was an interesting moment almost on the 4th of May. At the same time that the gold, and this was late in the afternoon, I think it was a Wednesday, gold surged like 20 or 30 bucks in a couple of minutes and then was right back down again. And at the same time, crude oil spiked down about $4 and was back up, you know, where it started, you know, 5 minutes later. So there was just some ripple went through the market in very thin, when I say Wednesday afternoon, that would be almost dinner time, say, in the East Coast. Anyhow, to come back to gold specifically, gold made that run from, let's say, last November up to the highs at the beginning of May. I think a couple of things were in play. One, that was a period when the U.S. dollar was weakening, and by the way, that 4th of May was the low for the U.S. dollar index, and it's been higher since then. That was part of it. There was, in fact, I think that was a big part of it. There was also, you know, worries that maybe inflation was going to get out of control, but something we don't often hear about, at least not over the last decade or so, was central bank participation in the gold market. And the gold fans out there really loved that story, that we saw in 2022 central banks of the world, particularly ones that weren't cozy with the United States in any way, bought record amounts of gold. And the thought here was that folks, let's say in China and Russia, had learned that America, as a weapon, if they were ever to get into a contest with each other, could grab some of their holdings, and whether it's treasury bonds or what have you. And so gold was seen as a safe asset, sort of beyond the reach of Americans to take it away from you. So the gold bugs certainly loved that story, and it was good. Now, it also begs the question of some of those same folks probably think central bankers are idiots when it comes to monetary policy, but, when they were doing something that the gold bugs liked, then, that they were lauded. Well, that's just one of the ironies in the market. So I think that was part and parcel of it. And like a lot of things, the market ran up like it did, pivoted and came down. I track the commitment of traders data, the open interest, and I was writing every week in my blog, particularly around the top, pointing out that there had been sort of a rush into the market right near the highs, and that the market therefore was vulnerable to a bit of a cascade to the downside. Now, forgive me, that's too strong a word. I mean, the gold price is down, all of 5% or something if we're down $100 on a $2,000 price. But the flood of people buying the gold futures market, and by the way, not so much the gold ETF market, indicated to me that if prices for some reason did start to fall, there was a risk that Johnny-come-lately buyers would have to turn sellers, or they'd get margin calls or what have you. So I think that accounted for part of that break that we've had. Go back to my longer-term picture here. We're going to have higher inflation in the future. I think that definitely puts some kind of a bid in the gold market. In the short term, I think the hot money people, hot money traders that want to jump in and out of markets are probably much more interested in what's happening in the NASDAQ and couldn't care less about what's going on in the gold market, like it's the barbaric relic from the old days. So we'll have our ups and downs, short term, longer term. I like the gold market.
WTI crude has traded sideways this year with prices mainly within a $70 to $80 range. Natural gas has also gone sideways between $2 and $3, way down from last year's highs of around 10. What are your thoughts on the energy markets?
Well, again, time frame here, but I guess maybe a longer term. The first thought that comes to mind is how how confusing the energy market is, and I subscribe to a number of services to try to keep up to date with that. But we're obviously in some kind of a transition here from fossil fuels to something else. At least a lot of folks hope that's what's happening. Hence, we're seeing less CapEx spent for people to try to find called in-ground inventory of to replace the stuff that they're pumping now. The oil, let's call it fossil fuel companies, seem to be attuned to the market and are paying dividends and spending less money on CapEx in a way just it's so similar to what the gold mining business did 10, 15 years ago when people were howling that they didn't want the gold mining companies to be hedging future production. They wanted to sort of the gold mining companies to be exposed to ups and downs in the price because those folks thought that the price was only going up. So we've had, I think, a very convincing story that says that with rising global population and people in the emerging markets looking at how people in the developed markets live, they want to live like us, so they want to consume more energy and so on, and therefore there's only one way that energy prices can go, and that's up. And like a lot of stories, sometimes they don't come true, or at least they don't come true on the time horizon that you were hoping. Yeah, we've been in kind of a quagmire here. Now, to be fair, the price spike that we had last year, and let's just use WTI, up to, call it $130 when Russia invaded Ukraine, and subsequently the price spike that we had in natural gas, and the spike in Europe was way spikier than the price we had in the U.S., but prices there got up to $10, and they're now down at $2 to $3. So we've had a tremendous correction from the classic exogenous event. I mean, maybe some people saw it coming, but clearly the market didn't see the Russians invading and the fallout that would have. And there was, last summer that the Europeans were going to freeze to death in the dark because they didn't have access to energy. Well, that's proved to be hollow. There was an amazing work done there to provide energy, and also I guess they were lucky with having a warmer than otherwise winter, but maybe those kind of problems come to the fore as we go into the next winter. In America, we've seen the data shows that Americans are now flying more than ever. The economy seems to be strong, but transport fuels have not been rising to in harmony with that. You might argue that releasing supplies from the strategic stockpile have kept the lid on prices. I don't know. We've got OPEC will be out this weekend with their regular meeting in Vienna, and they may come forward with more production cuts. And just this past week, we've seen oil, WTI, I should say, drop about $5 and then rally back about $5. Those are virtually 10% numbers. And, if we saw the stock market dropping and rising 10% within the course of a week, we think that was wickedly volatile. Well, the energy market's probably as important, if not more so, than the stock market in many ways. So, I watch it. I don't trade it that much. I may use the energy markets to give me a clue as to what I'm going to do in some other markets. But, I'm going to say your guess is as good as mine where we're going here with the energy markets, other than it's clearly going to be complicated. Some of the things I read about the American infrastructure, and I don't think Canada's going to be any better on this, or Europe either, the infrastructure to distribute electricity is just not up to the job of having electricity, however it's created, replace other fuels. So none of this transition thing is going to be easy, and it'll probably create all kinds of nightmares and fabulous opportunities, depending on which way you want to look at it.
The Goldman Sachs Commodity Index fell to an 18-month low earlier this week, down about 30% from last year's highs. What are your thoughts there?
Yeah, I think maybe the last time we talked, I think I mentioned about copper and how there was this incredible bullish story out about copper, that there wasn't enough copper to go around. It takes 10 years to find and develop a new mine if there's one to be found, and the ravenous demand for copper from the electrification of everything was just going to drive prices to the moon. Well, prices didn't go to the moon. They've been trending lower. One way of looking at it is I'm thinking, it's not a supply problem, it's a demand problem right now. And it seems, the China gets pointed to, and people say that's the cause of demand. The reopening in China just hasn't been as robust maybe as people hoped it would be or thought it would be. And across the board, we've got the grain markets. Wheat prices are down by more than half of what they were at last year's high, when, for instance, the Economist magazine, ran a cover basically saying, we're going to run out of food, with pictures of wheat on the cover. On the other hand, live cattle prices are up, and people buying a steak at the Safeway, to put on the barbecue this weekend, know darn well that meat prices are way up, and I'm going to tell you they're probably going higher from here. So we've had some choppiness there. The Goldman Sachs index that you point to definitely is energy heavy, so the fact that nat gas has fallen 80% from its highs and crude oil is down by 50% and so on is a big weight on the index. But yeah, I guess we haven't been back at these levels since around late 2021, so a good 2-year plus low on the index. I will watch it. I don't trade the index, but I will watch that as maybe it's telling us something about what the demand picture is in the economy. There's been a whole school of thought that says we're due to have a recession, and so far that recession has been postponed. The different components of what might cause that. Employment seems to be still very strong. Wages are moderating a little bit, but still pretty good. People are going to be able to continue to spend even if they're using credit cards and so on. The fact is, though, that the index traded down to the better part of a 2-year low. So what's going on? I think it's a demand function more than a supply issue, and I pay attention.
In your weekly trading desk notes on victoradair.ca, you write about different markets and how you're trading them, and you usually have a few thoughts about how you trade. Last week, for instance, you wrote about how risk management defines your trading process, that it's not an afterthought. What are your thoughts on trading this week?
Well, I had a brainwave the other day, something I thought of years and years and years ago, and that was to flip a coin to make a trade. Now, I think this is, I don't mean to make fun of anybody for sure, but if you were to look at a market, just select any market, okay, and you flip a coin and you have to buy it, like say right now. And then, you use your risk management, whatever that is, to manage the trade. So the trade's either going to go for you or go against you. Part of this would be, a week or 2 weeks ago, I interviewed on our podcast, the Money Talks podcast, Greg Weldon, who's a 20-year friend of mine, lives down in Florida. And he was reminding us that a market commentator from years ago, Van Tharp, had said that trading is 10%, like your homework, whatever you decide you want to be involved or not, 20% risk management, and the other 70% is psychology. I'm thinking, I'm always thinking about risk management, and I just think it's way more important. I think I've said on this show that, I make money from trading these markets because of how I manage risk, not because I got a great crystal ball. And I think I've been very fair here today to say, I don't have a real hard opinion, and I know for sure any market that's going anywhere, maybe other than the U.S. dollar, I feel is going higher. It reminded me of watching a client of mine back in 1984. He was a German. He was over in Canada working for a German company, and his beloved Deutschmark was just falling like a stone against the U.S. dollar. And he opened an account with me, and he kept buying the Deutschmark. That was, we had those prior to the euro currency. And he basically, over a few months, lost all of his money. And then, at the beginning, January of 1985, things turned and the euro just soared against the U.S. dollar for the next several months. So he hadn't managed his risks to the point where he could have been there, to catch the thing when it really made its move. So this idea about flipping a coin to manage risk, flipping a coin to select a market, and then having to depend upon risk management to look after the trade is just a way of looking at how important risk management is relative to trade selection. And just to wrap that up, there's a great lady that I've paid attention to for some time, and she was sort of the role model for the psychiatrist that was in the television series Billions. And she said that you make your trading decisions not on your fundamental decisions, but on how you feel about your fundamental decisions. In other words, you could be kind of bullish gold, but if you're really, really, really bullish gold, that might kind of overbalance your, let's say, open-mindedness, and you're going to buy gold anyway, regardless of come hell or high water. Anyhow, that'll be kind of the typical part of my what I call my thoughts on trading in my blog this week.
Victor, thank you so much for being on This Week in Money.
Jim, it's always fun to talk with you. I wish I could be more specific, but that's just in terms of buy this, sell that. But that's not the kind of advice that I want to give, because I'm very quick to change my mind if I buy something, I like it. As my old friend Dennis Gartman used to say, I have strong opinions, but they're just weakly held. And I think that's a great way to look at trading. You have to have some belief in something to put a trade on to risk your money. But at the same time, if your goal is to make money and preserve your capital, then if the trade's not working out, you got to be able to say sayonara.
Thanks again, Victor.
You bet, Jim.
My guest has been Victor Adair. Check out his website, victoradair.ca. He was speaking to us from Parksville, Vancouver Island. Coming up, Bob Hoye, next on This Week in Money.
Recyclico, making lithium-ion last forever. Recyclico's patented recycling process achieves up to 100% recovery of battery metals from lithium-ion batteries for electric vehicles, including cobalt, lithium, nickel, manganese, and aluminum. Recyclico Battery Materials Incorporated trades on the TSX Venture AMY, on the OTCQB AMYZF, and Frankfurt ID4. For more information, visit recyclico.com or phone us at 778-574-4444. Recyclico, making lithium-ion last forever.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. He's speaking to us from Vancouver. Welcome back to This Week in Money, Bob.
Yeah, hi, Jim. Here we have beautiful, let's call it an early summer day, and we even have a beautiful stock market the last few days, so that's kind of nice.
Is AI mania just like the 2000 .com bust where people just added the words .com to whatever they were doing and people would invest huge amounts of money? Most of those companies went bankrupt. Now, people are just adding AI to their company name.
Yep.
And trying to attract money. Is this very similar to the .com bust?
Oh, yeah. Yeah, and also keep in mind that seasonally on the stock market, April and May can often be very happy months for speculative items, and this is what's going on here. And some of the ones we're looking at are getting kind of technically overdone. It is the only game in town, which is a comment on advanced declines. Gosh, I looked at those the other day, and for the whole New York Stock Exchange, the ADs, it's very constructive when you got the senior indexes going up and the advanced decline line going up as well. But it has been rolling over the last couple of months and is not too attractive at all. And but then this even makes the kind of maybe it's six stocks against maybe 1,500 on the big board. You know what I mean? The hot six is sort of very limited advanced decline line, and they're going straight up and getting way overdone. So we'll watch and see how they do. And Jim, you're right on with the fact that it's everybody's got a company. They put AI on it, like everybody put .com on things back in 2000.
Yeah, and I remember back then a couple of 15-year-old kids sold a website to TELUS for $3 million. Just a website.
Yeah.
Yeah, incredible. Yeah. Now, some of the headlines that caught your eye.
Mm-hmm.
How U.S. farmland became a battleground in the fight against China.
Yeah, Chinese interests have been buying farmland along with Bill Gates, and farmland values are very high. So my thoughts on this is, let the Chinese companies and interests buy high, and if we go into a post-bubble contraction, and farmland values will come down, so they'll end up getting stiffed, and then it'll eventually fall into, at some point ahead, strong hands.
Yeah,
hopefully American hands, yeah.
Right. Now, Canada's problem is that our farmers are quite old, they're retiring, and nobody's taking their place. We have a labor or ownership shortage in Canada.
Yeah, I hadn't read about that, but I can well understand it, and the federal government's doing everything it can to disrupt agriculture. They got this weird idea that nitrogen is bad, but for 1,000 years, farmers have known well, 1,000 years ago, they didn't know it was nitrogen, but they knew to do crop rotation, and you put in peas or lentils in one field at one season, and it restored the vitality of the land. And they didn't know it was nitrogen, and the amount of nitrogen being put into the soil as farmers are seeding and then looking after it, they're very thrifty with that stuff. So it's just, again, it's Trudeau responding to his instructions from the World Economic Forum. So
in Peace River, it's gray forest soil. It's kind of nutritionally poor. My dad always grew clover and yellow peas, the kind you make pea soup with.
Right,
to put nitrogen into the soil. Yeah,
that replaces nitrogen. So, yeah.
And we had a granary full of yellow peas. Whenever you wanted yellow pea soup, you just went out with a bucket and got the peas.
That's fun.
Yeah. Headline from Reuters, the end of King Dollar?
Oh, yeah. Yeah, they're getting headlines about that all the time. There's a certain envy about if you're not the senior currency, you're envious of it. And I looked at that one a while ago when it was Argentina was complaining about that and proud to do a trade in the Chinese currency. But the truth of the matter was, if you read the rest of the article, was that their central bank was very low on U.S. dollars. So they didn't have the U.S. dollars to participate in trade. So, but I wrote a piece on it, Jim, and the decision of what is the senior currency and the world's financial center has always been determined by market forces. And going back 2,000 years ago, of course, it was Rome and their silver coinage, and plus the gold coinage. And then when Rome fell apart, the markets developed in northern Italy, specifically Florence, and eventually Geneva and Venice. But out of that, the financial center became Florence, and the currency was the gold florin. And that was into the 1300s. And then in the 1400s, in the mountains, Harz Mountains in Germany, there was a discovery of fabulous silver deposits, huge, very big silver deposits. And at that time, the family bank, the Fuggers, careful with that one, Fuggers, did actually become the biggest bank in history, all based on their silver mines and all that sort of stuff. So then also the coinage then was called the thaler, which was the way you pronounce valley. And this is how then eventually a major currency became known as the dollar, from thaler. So then you had Augsburg as the center and thaler as the senior currency. And then when prosperity really arrived with on the North Sea area in Northern Europe, and you had the lower Rhine River, lots of trade there. So the world, or the then European financial center, became a little harbor called Bruges. And then it silted up over a few generations, and the bigger ships couldn't get in. So then the market moved to Antwerp, and Antwerp became extremely prosperous, and the financial center, not of Europe, but the known world. And then when the Spanish Netherlands, in an insane move, they don't like freedom, did the Spanish Fury in the raid on Antwerp, some 7,000 people were murdered and about 1,000 buildings destroyed. So then the Dutch wisely moved their financial center to Amsterdam, which was more defendable. So then you end up with Amsterdam as the world's financial center and commercial center, and with the guilder as the key currency. And then in the early 1700s, as England became much more prosperous and London as a financial center grew, then you ended up, you could say, by the mid-1700s, sterling was the senior currency and London was the financial capital of the world. And then due to World War I, and Britain expended a whole lot of treasure on that. But eventually by the 1940s, you had then New York became the world's financial capital, and the dollar became the senior currency. And the idea that the Chinese could host the financial capital of the world with the senior currency, that ain't going to happen, because each residence for the senior currency and financial capital has been noted for freedom and trade and all that sort of stuff. So, no, and I think the U.S. is heading for a reform away from Marxism and back towards freedom, so I think that locks in the U.S. dollar being the senior currency and New York being the financial center for a generation or so yet.
Now, the so-called BRIC countries, that would be Brazil, Russia, India, China, South Africa, are trying to form their own trading bloc and perhaps their own currency, although India and China still have territorial disputes.
Yeah.
And probably aren't all that close together.
Yeah, well, India as an economic and political powerhouse is really coming along.
Yes.
But the world's financial center is New York, and the senior currency is the dollar, until financial and political forces change.
Yeah, someone said India should become the world's economic powerhouse because they're a democracy. The problem is they're a democracy.
That's a good one. Anyways.
Headline from Breitbart: French government told to implement wealth tax to fight climate change.
Oh, yeah. Yeah, you can just, giving money to governments, and you can change the weather, just like that. It's an amazing concept. And then I like the one about, the comment about the Wagner's group, about Putin.
Yeah, the head of the...
here's the headline. Wagner's group boss,
Putin's butcher,
says Russia at risk of losing Ukraine war and facing revolution. Now, the Wagner group is a group of mercenaries, and they've been in there doing a lot of the organization and nasty stuff and whatnot, but they have to have money. So when Putin started his adventure into Ukraine, crude oil had shot up to... roughly 130. And he always goes to war when crude oil is high. So now with crude oil down to the 68, 69 level, hey, where's the money coming from? And here is a comment by a key guy, the Wagner Group, and maybe Putin is behind on his payments to the Wagner Group, and the boss guy is saying, get with the program. So then if you get a recession this fall, Russia is going to have no money, and I think that the effort in Ukraine would come to an end rather quickly.
Now, we're being told gasoline prices once again this summer are expected to skyrocket. Why would that be, Bob, if the price of crude is low? And the friend of the show, Wolf Richter, said last year in the U.S., driving miles were up, but the use of gasoline was down because more people are driving EVs.
Yeah. Well, I don't like to comment about EVs. Yeah. They're impractical.
But on the gasoline side, Bob, it seems it's just they're raising prices because they can.
Well, if you take a look at the seasonal chart for gasoline prices, the high is typically at the end of May, early June, where we are right now. And so you watch for the overbought on it and maybe catch a trade going the other way. But quite likely, the highs for the year for gasoline are being set right now. So, and of course, Vancouver, I think, has the highest gas prices in the world. Now, and also, you got a lot of tax on these things as well.
Yeah.
So.
Now, one of the headlines that we have here from the Wall Street Journal, your coming summer of blackouts. That happened in California last year. They had power shortages.
Mm-hmm.
And so California, again, encouraging people to buy electric cars and then told them to park them because of an electricity shortage. We're not increasing our electricity inventory, are we? Or putting up more power lines?
I just this week had a piece published in the Canada Free Press on the power grid. And even when you have uninterruptible power, like hydro, nuclear, coal, natural gas, even with uninterruptible power, there can be failures. A sudden jump in temperatures or a sudden drop, a bird landing on a transformer and shorting things out. So this article reviews some of those examples. And then what you do when you have interruptible power, such as solar and windmills, you got a problem, a built-in instability for the power grid. So the power grid can go down when you have non-interruptible power. And this is where the headline, it's a very succinct headline from the Wall Street Journal, is absolutely right. There will be shutdowns, probably before the summer's over, due to a sudden surge in heat. And then you go into the winter, and there'll be shutdowns due to a sudden drop in temperatures. So I know, there's a good one. And on this one, Jim, it was, I think, 1965 or 66, the northeast, including into Ontario. And there was a very sharp drop in temperatures. I think it was November the 9th, and right down into the rush hour at 5 o'clock going home, and I think it all shut down at 5:17, so people were trapped in Midtown Manhattan, and the bars did a lot of business. And then there was also a rumor at the time that everybody had such a good time because the power shortage hit the cocktail hour. There was a surge in births 9 months later, but I looked into that, and that wasn't really substantiated, but it was a fun story from the time. So, and this was in either 1965 or 66, so this was before there was interruptible power, and you could still have the grid shut down. So what we're in now is is electricity being delivered by crazy political forces, and as you point out, they also want everybody to have electric cars. And then they tell people they can't drive their electric cars because there's not enough electricity. So there really is mad out there.
Yes, another headline that caught your eye, the war on things that work.
Isn't that a great line?
Now, what's behind it, Bob?
Again, let's call it the woke world, that somebody gets an idea. And this has been on for the last 4 months or so, where somebody got an idea that gas stoves were bad. And they want to ban gas stoves. Now, God, every important restaurant has a big gas stove and range and all that sort of stuff. So this is what it's about, where somebody suddenly gets passionate about something and is able, with an uncritical media, to promote it into an international issue. And this is where the disruption comes in. They just, all of a sudden, they don't want gas stoves. And it's just breathtaking to look at this. And, of course, I've been around long enough to recall when things were relatively normal. Sure, 1974 with the first energy crisis and the high inflation then did bring on briefly shortages. That was sort of startling. But this one you've got in the COVID shutdown, just bang like that, never happened in history. And at the same time, the central banks only know of one thing they can do, and that's to flood the money markets, either with credit or currency. So no wonder you got a bulge in prices. And then, as I say, in the States and in Canada, governments are doing their best effort to shut down oil and gas and the transportation of oil and gas. So that's why we live in this wild world. So who knows? But I think that when governments go really broke and the public is really out of money, then all of these fanciful experiments will stop and a reform will get underway.
Well, it looks like Biffy and Buffy will have to, Biff and Buffy, I should say, are going to have to fire up the yacht this year because there's a glut of inventory hitting the Hamptons as rental demand cools for the summer.
Yeah.
What is happening there in the Hamptons?
Oh, when you live in Manhattan, it's very pleasant to have a place up in the East Hamptons on Long Island, and some of the really grand places where you got waterfront. Jim, listen to this. The rent for 5 or 6 weeks of summer usage is in the order of $2 million. That was last year. But this year, there's the demand for rental places is cooling because some people are just kind of running out of the money. Even paying $150,000 for 4 or 5 weeks for a modest place is still a lot of money, you know. So again, it's the high-end stuff that is suddenly people are finding it unaffordable.
Well, according to TMZ, Kenny G is renting out his palatial place to Jeff Bezos and his fiancée for just $600,000 a month.
Wow, there you go.
So there's a bargain for you.
Yeah.
I guess Jeff just can't stand it on that tiny little $500 million yacht he has.
Yes. No, Kenny G, is that the guy who played the soprano saxophone?
Yes, it is.
Oh, God, I can't stand him.
Well,
even when he was the rage, it must have been 40 years ago when suddenly that came on as the new music, so...
Well, Bob, you're a fan of the real saxophone players in jazz bands, aren't you?
Oh, Johnny Hodges on tenor is some of the greatest, and Ben Webster on tenor, and then Harry Carney out of the Ellington Band on baritone sax. It's a great instrument when played right.
Bob, always fun talking with you.
Yeah, we had a fun time today working over our headlines and the craziness out there.
Thanks again, Bob. My guest has been Bob Hoye, market historian and chief investment strategist for chartsandmarkets.com. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, Victor Adair, and Bob Hoye. And thank you for listening. Again, if you have any questions for our guests or for the show, you can send them to info@howestreet.com. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at talkdigitalnetwork.com. This Week in Money is a production of Howe Street Media Incorporated. Executive producer is Tom Allen.